Hi guys, Lynette Zhang, Chief Market Analyst here at ITM Trading, a full-service physical precious metals brokerage house. And we're going to be talking a lot more about bonds in the days to come, particularly with the rate increase. And we do know, because we've been looking at it, that our two biggest foreign creditors, especially in 2016, have been selling off U.S. Treasury bonds. So really what I want to talk about today is patterns, because when a pattern shifts, it matters, even if you don't know why it matters. So let me show you, okay? This goes all the way back to 1774, okay? And you can see when we were on the gold standard, purchasing power, the money supply, inflation, were pretty much flatline. But this is when, really right here is when the shift occurred, 1913, and you can see it looks like a hockey stick. The reason why that matters is because that's how money is created in our system. But looking at a long-term chart, you can see that pattern shift. Okay, well, let's look at today. Now, this goes back to, let's see, when does this go back to? The 1990, all right? So it picks up from there. But can you see right here where I have long-term capital management, LTCM? That was the first derivative explosion. And you can see that pattern shift that indicated that they were bailing something out. And then look at the speed that the debt increased. In other words, increasing the money supply to inflate the currency and pull us out of a problem. Now look at this. This is when the 2008 crisis hit. Can you see how that pattern then shifted as well? And it got a whole lot more choppy. So what I'm trying to show you here is that every time there is a pattern shift, that means that something is going on in these markets. And you could see it clearly from a distance. So the pattern shift that we're going to be talking more about as time goes on is really what's happening with interest rates. And there are a number of reasons why that matters, and we'll talk about that as we go on. But what I really want to show you a little bit more is this, do I have it the right side? Nope, upside down, sorry, is the interest rate pattern shift. Now this is the 2-year, this is the 10-year, and this is the 30-year Treasury bond. And I'd like you to see, I don't know if you can see this, but go to the JPEGs, they'll be underneath there, that the current 2-year rate as of today is as high as it's been back in 2009 as the crisis was unfolding. We see that actually since mid-2016, interest rates have clearly been rising, but this could be a signal to a shift in those interest rates. Plus, we have the Fed that is most likely going to raise on March 15th. That's a trigger date that we wanted to pay attention to. But this is really one of the reasons why a raise in interest rates or an increase in interest rates matters to you. And that's because of the carrying costs on this mountain of debt. All the carrying costs on that, okay? So there's defaults and sovereign bond defaults, et cetera, et cetera. But this is one of the big problems coming up with it. Now, increasing debt doesn't really matter as long as you have the income to service that debt. We all know that from an individual level. But this is the monetary velocity, which actually indicates whether or not an economy is being stimulated. This little insert chart here is from the Federal Reserve comparing the monetary velocity today to the monetary velocity during the Depression in 33. This goes to 2013, and that's why I put those red arrows in there. So it should be pretty clear that the monetary velocity, or the speed at which money changes hands and indicates whether or not an economy is being stimulated, you can see that does not look like it's stimulated. you can also see that this is true on a global level, which is what that graph indicates. So can you see this problem? We've got mountains of debt, rising interest rates, and we've got declining income to pay it. It's a bit of a problem. Okay, so we're going to talk more about this in the future, but the other thing I wanted to talk about is what is happening in the silver and gold spot markets. This was a silver dump that occurred last night. And I don't know if you can read everything that I have on there, but each contract on silver controls 5,000 ounces. And the contract's worst case scenario, if you're like a Chase or a Wells Fargo or Goldman Sachs, one of those guys, it costs you $1.45 for each contract. So it's not very expensive to do a complete dump. The same thing is happening, or a similar thing is happening in the gold market this morning. So the thing that I want to point out to you, and how you know it's an indication of manipulation, besides all of this happening in light trading where they can push it down so well, is again the supply, and you can see the deficits, and the demand. Okay? It's all about patterns. It's all about logic. If you can get those two little pieces, nobody's going to be able to pull the wool over your eyes. So that's it for today. Like us on Facebook, subscribe to us on YouTube, follow us on Twitter, and give us a call, 888-696-4653, and be safe out there. Bye-bye.